All right, so in this video, I'm going to talk briefly about financial risk. Financial risk is the risk that is due to capital structure decisions, specifically how much debt and preferred stock a firm is utilizing to finance the firm. So financial leverage is going to be specifically the extent to which fixed income securities are used in a firm's capital structure. So when I refer to fixed income securities, we're referring to securities that have fixed financing costs. So if you think about interest on debt, the company has to pay the same level of interest whether they have a good year or a bad year. And most of the time for companies, the typical bond has a fixed interest payment, for instance. Preferred stock, same kind of thing. The dividend is generally fixed. Now, in the case of preferred stock, there is sometimes a little bit of wiggle room where the company might be able to essentially defer the payment of the dividend for a period of time. But ultimately, if they ever want to pay dividends on that common equity, most of the time, if it is kind of cumulative deferred, they have to make it up. So in that sense, it's pretty much a fixed cost. So if the company has a good year, they pay the lender the interest, and they pay the preferred shareholder the dividend. If they have a bad year, they pay the lender the interest, they pay the preferred shareholder the dividend. So basically, what that means is when we're looking at financial leverage, and it's the extent to which fixed income securities are used in a firm's capital structure, it's all about the extent to which a firm has financed itself using some combination of preferred stock or debt. And basically, what's happening is if a company has a really good year, if there is preferred stock or debt, basically what happens is those costs, the interest expense, the preferred dividends stay the same. So all that extra good sales and profitability and operating profit that's been earned, all that extra, it goes straight to the shareholders, the common shareholders. And so basically that's extra, good result for them. On the other hand, if I have a really awful year, the interest and the preferred dividend is still fixed. And so if we have basically a really bad year, I still have to pay the interest. And now I could have a situation where the shareholders are basically making up the difference, and they take the entire losses or something like that, right? So from that standpoint, financial risk is all about whether a firm has debt or preferred stock. And significantly, the interest rates on available debt do vary with the capital structure. So I talked about this with the cost of capital material in prior videos. So basically, if a firm has borrowed a lot of money relative to other forms of capital, the cost of equity is higher, the cost for the preferred shareholder would be higher, the cost of debt would be higher. So basically, the interest rate would be higher. On the other hand, if the firm has virtually no borrowed money at all, then in that case, well, if they borrow a tiny bit, then the interest rate's probably going to be somewhat lower because they don't have much debt, and so they don't pose as much risk to the lender. So financial risk is all about basically borrowed money and preferred stock, these kind of fixed income or fixed costs kind of obligations to the company that they have to pay whether they have a good year or a bad year. And that's the idea behind financial risk. Hopefully this has been helpful. Thank you so much for watching and have a great day.